So we're now going to begin looking at financial statements. And financial statements is something that you learned in Accounting 101, but now we're going to be looking at these from a manufacturer's point of view. In Accounting 101, you may not have noticed, but you were creating balance sheets and income statements and so on for a merchandiser. And so now we're going to be concentrating on the actual manufacturing process. So along with that, we're going to be looking at the statements that go. So by definition, a merchandising company is someone who buys goods in order to simply resell them. They're a retailer. A manufacturer, on the other hand, rather than buying something to resell it, they buy raw materials and convert them into their finished good, and it's that finished good that they sell. So when we talk about a manufacturer's balance sheet, we're going to be adding some information when we talk about inventories. If you'll remember, when we talked about merchandisers, and again, you didn't specify that it was a merchandiser in Accounting 101, but the basic balance sheet that you learned for current assets, you had your cash, receivables, and your inventory. This inventory that you talked about was merchandise inventory. It was inventory that had been purchased in order to resell. So what we're concentrating on is the difference between the merchandiser's inventory and the inventory you're going to have with a manufacturer. So when we talk about inventory with a manufacturer, we've got three different categories. We've got raw materials, goods in process, and finished goods. I'm going to go ahead and say this because this is just a difference between how I talk and how this book refers to these. I'm often, and just because it's what I'm used to, going to probably say work in process. Goods in process or work in process is the same thing, it's just a different term. So these are all different types of inventory, and it's simply showing us where in the manufacturing process a certain item is. Is it a raw material, meaning it's something that we have purchased but yet to have done anything with it? If it's a work in process or goods in process, this means that it has begun to move through our manufacturing process, but it is not ready to be sold at this point. Finally, finished good. A finished good is an item that is completely finished being manufactured and it is ready to sell to our customers. So now we can begin to look at the differences between the income statement for a merchandiser versus a manufacturer. And namely, what we're going to be looking at is how do we get to the cost of goods sold for each type of company. So first, let's just, as a reminder, look at a merchandiser. With a merchandiser, to calculate cost of goods sold, you have your beginning merchandise inventory plus the costs of any of the goods that you purchase. And the sum of these is the cost of goods available for sale. Subtract out what you have left over at the end of the period, and that's where you come up with your cost of goods sold number. Now we're looking at a manufacturer. The biggest difference here is that rather than starting with a beginning merchandise inventory, we start with beginning finished goods inventory. And let's emphasize here, we're not talking about our raw materials inventory. We're not talking about our work in process inventory. We're only looking at the goods that were already complete at the beginning of the period. So this is the beginning finished goods inventory. Add to that the cost of goods manufactured. When we talk about cost of goods manufactured, we're only talking about the goods that we completed during the period. We're again not talking about anything that sits in raw materials, nothing in work in process, only those items that we have completed and transferred out of work in process and into finished goods during the current period. So these together, the beginning finished goods inventory and then those goods that we have manufactured in the current period, give us the cost of the goods available for sale. We'll then subtract out whatever we have left over in our finished goods inventory at the end of the period, and that's how you come up with a manufacturer's cost of goods sold. At this point, we're really just looking at differences in terminology. The basic movement is the same. Here we just have two examples of what we were talking about of actual income statements. You can compare and contrast those. Then we're going to begin looking at how do these different costs and inventory items flow throughout the manufacturing process? So first, what you can see here, we've got raw materials, work in process, and then over here we have our finished goods. The first thing I want to note is that these three items, these are all assets. So as we transfer from raw materials to work in process and then finally to finished goods, these are all what we call asset transfers, meaning we're just transferring values from one category of an asset to another asset category. The net effect on our overall balance sheet is nothing because one asset decreases, another one increases. Then when we finish something and we sell that item, that's where we're going to see an effect on our balance sheet and then on our income statement, because when we sell something, that's when it leaves the inventory category and it becomes an expense as cost of goods sold. So here you can see our raw materials. We can have our beginning raw materials inventory and then anything that we purchase. Those can then be used in the production activities and they go into work in process, and those are part of our direct materials. We then have in work in process the cost of any of our direct labor and then any factory overhead that is applied to the work in process. So you can see here whatever we began with in work in process plus our three product costs give us all the activity within work in process. Anything that we complete during the period then leaves work in process and goes into the cost of goods manufactured. Again, the sum of whatever was already finished at the beginning of the period plus what we manufactured during the period is going to represent the cost of goods that we have available for sale. Now, we can assume that we will sell some items, however, other items will remain unsold. Anything that remains unsold stays on our balance sheet and it's going to be part of that finished goods ending inventory. On the other hand, anything that we do sell is going to need to be taken off of the balance sheet because we no longer own it. It's now in the hands of our customers. And we're going to have the expense, which is the cost of goods sold expense, and that represents the fact that we have now used up the value of that resource and it no longer needs to be on our books. We can now look into what we call the cost of goods manufactured schedule. And this is just a schedule that's going to summarize all of the activity within the manufacturing process. You can see here is a basic outline of the cost of goods manufactured, and as we move forward you'll see there's a lot more detail that goes into this, but this is just a summary of all the different activity we're going to look at. You'll notice here we have our three product costs: direct materials, direct labor, and factory overhead. The sum of these three things is the sum of our product costs, so that's going to be our total manufacturing costs in the current period. Add to that whatever we already had in our work in process. That gives us the total amount that we're working on here. Subtract out whatever it is that we finish, and that gives us the cost of the goods that we have manufactured during the current period. You can see here is a picture or a statement of our manufacturing statement, the schedule of cost of goods manufactured. So you can see here we then look at in detail of the different sections that we saw on the other side. So you can see first we look at the activity within our direct materials. So we begin with our beginning balance in raw materials. Add to it whatever it is we purchase, and that shows us all of the raw materials that we had available for our use. When we compare everything that we had on hand to what we have on hand at the end of the period, that tells us what raw materials we actually used. And what that means is if we used raw materials, we have transferred them out of the raw materials inventory category and into work in process. So they have now begun to be used. Direct labor is pretty straightforward. We've just got one line item for direct labor. And then finally we have our factory overhead. Overhead contains lots of different items. We've got any of that supervision type labor or labor that is related to, for example, keeping up mechanical issues on the machinery. You've got repairs on your factory equipment, property taxes, supplies, insurance. Any of those bigger items that apply to the factory overall are going to be in this factory overhead category. So when you add all of these together, we have our total factory overhead. So the sum of the direct materials that were used, the direct labor for the current period, and the factory overhead that we have applied is going to give us our total manufacturing costs. So these are our product costs. We add to that whatever was already in process at the beginning of the period. So the sum of those tell us what was the total cost of work in process during the period. If we compare that to whatever is left over in work in process at the end of the period, the difference is the amount that we transferred out of work in process. So that is the amount of items that were actually completed or manufactured. So where do those transfer to? They transfer out of work in process and into finished goods. So here you just have a depiction of why we put together these various statements. So you can see here we've got the schedule of cost of goods manufactured, and we put this together to give us the detail behind the manufacturing process. We then use this information here, the cost of goods manufactured, in our income statement. Cost of goods manufactured is going to be used because we need to know what we created during the year to help us come up with our cost of goods sold. Again, just to emphasize, the beginning finished goods plus the cost of goods manufactured. The sum of these is the cost of goods available for sale. So then the difference between the total amount available and what is left over gives us our cost of goods sold. And this cost of goods sold number is so important on our income statement because it's the first expense and usually the largest expenses for a lot of companies. Then you can see here the amount of our finished goods that still remains on the books. Those are going to be here as our finished goods inventory on the balance sheet. We've also got our raw materials and the other work in process that make up the other two categories of inventory for a manufacturing company. Moving forward, we're going to briefly discuss some trends in managerial accounting. As our world, and particularly the manufacturing world, becomes more globalized, there's a lot more competition, and specifically right now we're talking about for U.S. companies, because United States companies are now having to compete with companies like China or Mexico where labor and costs are less. So when we talk about certain trends in managerial accounting, most of those trends are related to the fact that our environment is becoming more globalized and therefore more competitive. So these are different things that U.S. companies are looking at in order to help remain competitive. So we're looking at a focus in customer orientation. We're looking at a focus on service. E-commerce is becoming very important, doing commerce electronically, whether or not that means that our different systems work together, and that goes along with these ideas of lean practices and value chains. You'll see customers, companies, manufacturing companies now, working and using e-commerce to work directly with their suppliers. So an example in some business-to-business type transactions is where a manufacturing company's computer will be set up to talk to their suppliers. And whenever the manufacturer's computer notices that they're getting low on certain types of raw materials, it will automatically order those from its suppliers. So we're using e-commerce to make things more efficient and more effective. Lean practices, what we're looking at when you talk about lean manufacturing is getting rid of any types of waste. So you're looking at activities that are not value added. So for example, in the manufacturing process, when we talk about value added, we're talking about when we're actually producing something with value. So if you're talking about the company that makes bikes, actually putting the tires onto the bikes, that is adding value. However, let's say that we have to move the bike from point A to point B. It's leaving this line and it needs to go to another line. Let's say it's now been put together and now we need to paint it. That movement, when it moves from point A to point B, we are not actually adding value in that area. Instead, we're wasting time and resources because it takes either labor or some type of machinery to move our goods. So with lean manufacturing, we want to get rid of any of those activities that do not add value. And that might be through rearranging your manufacturing facility so that you don't have to actually pick up things and physically move them. Instead, you'll lay things out so that they run more smoothly. When we talk about value chain, we're looking at the chain from suppliers to people who then go and sell your products and making sure that you're adding value at every point in that value chain. So as I mentioned, along with this globalization of manufacturing, we've had to come to a customer orientation. So along with that, a couple things that have come is this idea of continuous improvement. Oftentimes, and it's just a key word that you'll hear thrown out in manufacturing discussions, rather than saying continuous improvement, the Japanese term for continuous improvement is Kaizen. So this is a very common and popular term right now in the manufacturing world. The idea with continuous improvement is that you're improving everywhere in the company, not just in one area. So along with this brings this idea of total quality management, and then something that we'll talk about, which is just-in-time manufacturing. So first, with total quality management, what we're looking at is managing the quality of the entire company. So we're not just looking at financial aspects. We're looking at all aspects. So we're looking at waste, and with that comes in the value chain and lean manufacturing. We're looking at the quality of what it is we make. That's also the quality of working situations for our employees. We want to keep them happy, keep them focused. And we're looking at finding new methods and new trends to help us remain effective and efficient. One thing that we've already briefly begun to introduce, and I mentioned with e-commerce, is now becoming important, and the idea of two companies having systems that actually interact together. What this has allowed us to do is to use what we call just-in-time manufacturing. And what this does is, in the manufacturing facility, rather than having a large amount of raw materials sitting around waiting to be used, we now use what we call just-in-time manufacturing. And that's where we're only getting our raw materials from our suppliers just in time for them to enter the production process. Why do we do this? This all has to do with value chain analysis and lean manufacturing. The idea is that anytime we have raw materials just sitting around, it's very costly. We have to have extra space, and so that's either extra rent or extra space being used up in our manufacturing facility to allow these raw materials to just sit around. There is no value added when materials are just sitting around. Instead of value being added, there's actually value that's usually being lost. Raw materials can go out of date. They're no longer going to be useful. They can get damaged. They can become obsolete. They could be lost. There could be some type of fire or a flood and a large amount of raw materials sitting around. They're all going to be damaged, and it's going to be very costly. So to get rid of some of these costs, we've come up with just-in-time production. And we're able to do this through the idea of e-commerce and businesses working together. So along with the idea of businesses working together, we can really begin to analyze the effectiveness of our value chain. And I mentioned the value chain is just the different activities from the beginning when you're acquiring your different raw materials all the way to when you have already sold things to your customers and you're providing service. You want to make sure that at every link in this chain you're adding value. And a new idea that has come around, and the idea of businesses working together. When you think about a manufacturer and their supplier, in the past these were more adversarial type relationships. A certain manufacturer had many different suppliers, and they were generally those suppliers were having to compete to have the lowest price for that manufacturer. Now, because of this idea of just-in-time manufacturing, rather than a business working with many different suppliers, lots of manufacturers have narrowed down the number of suppliers that they're working with. They're working with a smaller number of suppliers, and they're working directly with those suppliers. Their systems are linked. Their systems can automatically order things. They can talk to each other, and they have a better relationship. They're working together, and therefore they're adding more value through these different relationships. So along with the idea of lean manufacturing and just-in-time inventory, I want to introduce the raw materials inventory turnover ratio. And this ratio is going to give us an idea of how efficient a company is in managing their raw materials. So the raw materials inventory turnover is a simple calculation. The numerator is going to be the raw materials that we have used in the manufacturing process. We'll divide that by the average materials inventory. And what this is going to tell us is how quickly are we using the raw materials that we have on hand. The lower this turnover ratio is, that means that we are keeping raw materials and they're sitting around for longer. So typically, a higher raw materials inventory turnover is going to tell us that we are turning things over very efficiently. We're getting raw materials in and we're using them immediately. We're not having them sit around where they're taking up some of our resources just sitting around. So again, a higher raw materials inventory turnover is typically better. However, you want to be careful that you are properly managing your raw materials. The problem that can come in with just-in-time inventory is that if you're not very careful in how you manage these, you won't have any buffer. So if for some reason your supplier is even a couple minutes late on getting your raw materials in, if you're cutting it that close, you'll have to shut down your machines, because if you simply don't have raw materials on hand, you can't continue manufacturing. And anytime machines have to be shut down and things have to stop, that becomes very inefficient, and it can be bad for the machines to have to shut down when they weren't planned to be shut down. So although you want to be getting your raw materials in and immediately using them, you do want to create a little bit of a buffer to allow for error or things happening slower than originally planned.